working in, well, pretty volatile times for the market, aren't we?
Uh-huh. Definitely keeps you on your toes.
It makes you wonder what signals, what to even pay attention to. What might give us a clue.
Exactly. And today, we're diving into something, well, really unusual that happened in the S&P 500.
Something pretty rare, right?
Yeah, a type of market behavior that's only shown up 5 times in almost 100 years.
Wow. And the last time was way back, near the Great Depression.
That's right. The Motley Fool actually highlighted this, and that's kind of our jumping off point for this deep dive.
Okay, so the mission here is what? To understand this event.
Yeah, understand the event itself, what history suggests might happen next, and probably most important, what it might mean for you, just trying to stay informed about the market.
And the context lately really sets this up. I mean, the S&P 500 peaked back in February.
Right, but since then, it and the Dow Jones have dipped into correction territory.
Which is, a significant drop. And the NASDAQ.
The NASDAQ actually entered a bear market. First time in 3 years for that.
So a lot of movement. And April was especially turbulent.
Turbulent is a good word. The S&P 500 had its 5th worst 2-day percentage fall in 75 years.
That's huge. Over 10% down at one point.
Yeah. But then in the same month, it also had its biggest single-day point gain ever.
The biggest jump in actual points, not percentage.
Exactly. And we saw similar big point jumps in the Dow and NASDAQ too, just underscores the wild swings.
Which brings us to the really fascinating part. That S&P 500 drop in April, more than 10% down from the end of March at its worst point.
Mm-hmm.
But then it closed the month down less than 2%.
Right. That sharp fall within the month, followed by that strong snapback. That's the really unusual bit.
How unusual are we talking?
Well, like you said, only the 5th time since 1927 that the index dropped more than 10% intra-month, but then closed within 2% of where it started the month.
And the last time was September 1938, middle of the Great Depression era.
Precisely. It's quite the historical gap.
And this pattern was noticed, you mentioned.
Yeah, flagged on social media by Subu Trade, described as a multi-strategy macro trader, someone looking for these kinds of historical echoes.
Okay, so let's dig in. What could have been driving that kind of volatility recently? What caused that big swing?
Well, a few things were likely at play. A big one was President Trump's announcement on April 2nd.
The tariffs.
Yes, the 10% global tariff, plus talk of higher reciprocal tariffs on certain countries, that definitely seemed to unsettle the markets.
Yeah, that caused the initial tumble, didn't it?
Seems like it triggered that first big drop.
But then didn't things shift a bit just a week later, around April 9th?
They did. There was an announcement pausing those higher tariffs for 90 days.
Okay. Except on China, right?
Except on China, yes.
Right.
And that seemed to fuel those market rallies we saw.
Yeah.
The market bounced back.
It just shows how sensitive markets can be to this kind of policy news.
Absolutely. And tariffs, they're complex. They can ripple through trade, inflation, economic growth. It's not straightforward.
And it wasn't just tariffs creating nerves, was it? The Motley Fool piece also mentioned market valuation.
Right. How the S&P 500 was valued coming into 2025. They used the Shiller PE ratio.
Okay, remind us what that tells us.
It basically compares current stock prices to the average inflation-adjusted earnings over the previous 10 years. Gives a longer-term view of valuation.
And what did it show?
It showed the market was at its 3rd priciest level in, over 150 years.
Wow, 3rd highest ever.
Yeah. And historically, when that ratio gets above 30, which it was.
It often comes before a significant market downturn.
That's the historical pattern, yes. It doesn't guarantee anything, but it adds to the picture. A pricey market meeting new economic uncertainties.
Okay, so that's the setup. Volatility, tariff worries, high valuations. Now, the core question. That quick recovery in April, bouncing back after the big drop, what does history say happens next?
This is where that rare pattern becomes really, really interesting.
Okay.
The analysis looked at the 4 previous times this happened. That 10% plus intra-month drop, followed by closing down 2% or less.
And last, 1 year later, the market was down every single time.
100% of the time. Seriously.
100% based on those 4 instances.
Okay, that's definitely a pattern you notice.
Yeah.
What kind of decline are we talking about on average?
The average decline over the following 12 months for those 4 instances was about 15.3%.
15%. Oof.
Yeah. Now, huge caveat here.
The Great Depression context.
Exactly. The most recent observation was 1938. That was a unique, severe economic time. We can't just draw a straight line from then to now.
Absolutely not. We have, much better economic understanding,
Sure.
central bank tools, government responses. Things are different. A repeat seems incredibly unlikely.
Totally agree. That's a critical point. But there's that old saying, history doesn't repeat, but it often rhymes.
Hmm.
This pattern, this specific type of market whipsaw, historically suggests weakness ahead in the following year. So it raises a question, even with modern safeguards, are markets still reacting in ways that echo the past? It's definitely food for thought. But we shouldn't get tunnel vision on just this one indicator, should we?
No, absolutely not. And the source material, The Motley Fool, makes that point too. They pivot to the bigger picture.
The long-term view.
Exactly. Because short-term swings, even dramatic ones like this, are part of the deal. Downturns happen, they're inevitable.
But the long game for investing in something like the S&P 500, that's a different story.
A very different story. The historical data there is overwhelmingly positive.
And they use data from Cressmont Research for this part, looking way back.
Yeah, looking at rolling 20-year total returns for the S&P 500.
Yeah.
Going all the way back to 1900, which is, a really comprehensive view.
20-year chunks of time. What did they find?
This is pretty amazing. They looked at all 106 possible rolling 20-year periods ending between 1919 and 2024.
Okay.
Every single one of those 106 periods delivered a positive annualized total return, including dividends.
Wait, every single 20-year period, through wars, recessions, everything.
Every single one. If you picked any start date and held for 20 years within that long time frame, you came out ahead.
That really speaks volumes about patience, doesn't it?
It absolutely does.
Yeah.
Time in the market, not timing the market, as they say. Whatever happens short term, history suggests staying invested in a diversified way pays off over the long haul.
Okay, let's try and wrap this up then. The main takeaway seems to be this weird market action in April
The big drop and quick recovery.
is super rare. Only seen it a few times. Last time was back in the Depression era.
Right. And historically, those few times were followed by negative returns over the next year, an average drop of around 15%.
That's the short-term historical flag, let's call it.
Yeah. But, and this is a big but.
You absolutely have to balance that with the long-term perspective.
Exactly. That Cressmont data showing consistent positive returns over any 20-year period is just as important, if not more so, for most people's planning.
So it's kind of a nuanced picture, a potential short-term warning sign based on a rare historical pattern. It's set against a very strong backdrop of long-term market growth and resilience. History gives us these interesting correlations, potential clues maybe, but it's never a crystal ball.
Never. The future isn't guaranteed. So the real question is how you process this kind of information. How does a short-term indicator like this fit with your own long-term strategy and your comfort level with ups and downs?
Which leaves a final thought for you, the listener, to chew on. Given this rare historical pattern hinting at potential near-term headwinds, but also knowing the market's proven long-term power, how does that shape how you stay informed and think about your own financial path forward?
Definitely something to consider. Hopefully this deep dive gave you some useful perspective on this pretty interesting market moment.